Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. A couple weeks ago, we at BMO ETFs launched a new product, the BMO Global Agriculture ETF. The ticker is ZEAT, Z-E-A-T. So today what I really wanted to do is get into a bit of the story behind that and the reasoning around why we launched this and why we think this is a great exposure to add value to your portfolio right now. So we're really going to focus in on global agriculture this week. We'll walk through some of the tailwinds behind the sector and talk about some considerations to think about if you're incorporating it in your investment portfolio as well. So just a reminder, today we're not providing you any advice or investment recommendations. Today's show, like all of our shows, is just about education around markets, around investing and using ETFs for Canadian do-it-yourself investors. So with me today, I have Mirza from our ETF Portfolio Manager desk. So thanks for joining us, Mirza, your first time on the show. Mirza has really been instrumental in building this new ETF and coming up with the methodology behind it. So he's a great addition to today's show. I'm also joined by Erin from BMO Capital Markets, another Erin. He's a senior economist and director, and his coverage is really relating to the North American agri-food industry. So he's another great expert on the topic, so looking forward to our discussion today. Before we do get started, just a quick reminder, check out our YouTube channel and please subscribe and ring that bell so that you get notified every Friday when a new episode goes live. So to kick things off, just for our 1-minute update, I wanted to give an update on something that was announced, I think it was a week ago now. I had COVID last week, so everything's a bit of a blur, but I believe it was a week ago. Where CIFC, which is the Canadian Investment Fund Standards Committee, has actually taken steps to organize the different approaches to responsible investing and has created a framework where they can categorize the different funds available. So I wanted to highlight this because I think it's a really important step in the industry. I think we definitely needed more transparency around responsible investing and around how fund managers are managing to that responsible investing mandate. I think it'll cut down on greenwashing and all of those things. So this is definitely a positive. You can see that the funds there's 6 categories, and just to note that funds can fit into more than one category. That's important. But the 6 categories are ESG integration and evaluation, thematic investing, so things like clean energy or gender diversity funds, ESG exclusions, impact investing, so funds that intend to make an impact on an environmental or a social issue. ESG engagement and stewardship, so all around that voting aspect of investing. And then lastly, ESG best in class. So on our channel, we've talked a lot about BMO's ESG Leaders Index ETFs. And just for your reference, those would fall into ESG best in class and ESG integration and evaluation. So I just thought I'd share that. I think it will definitely help investors if you are interested in responsible investing or you are investing responsibly. Just make sure you're understanding where the products fit, and it'll help you understand exactly what they're doing within the mandates. All right, Mirza, thanks for joining us. Let's get talking about global agriculture. So I mentioned BMO ETFs launched ZEAT a couple weeks ago. Can you walk us through an introduction to this ETF around what exposure it gets you and how it's constructed?
Yeah, absolutely. I'm excited to be here to talk about our new ETF, the BMO Global Agriculture ETF, or as we like to call it, ZEAT. So this fund is kind of an addition to our real assets suite of ETFs, which already includes funds like ZGI for infrastructure and ZMT for materials. And so the idea behind the fund is to invest in global agricultural equities and invest in firms that are very closely tied to the agriculture production process. right? So if you look at the food supply chain, you have the grocery stores, the retailers on the consumption side, and you have the farmland, the agriculture services, the commodity traders and producers at the start of the food chain. And so this fund is designed to invest in those production related companies. So what we do is we try to go ahead, we look at all the global agriculture equities listed in North America, and we compose our portfolio based on that. So before I go deeper into portfolio construction, I'll talk about the purpose of the fund, and that is twofold. One is it can be a good inflation hedge, which as we've seen in 2022 has been super important. As well, it ties into the long-term organic growth and demand for food. As the world population grows, the demand for food continues to grow, and that is where the fund can also shine in the long term. So twofold: one, inflation in the short term, very topical, and in the long term, the organic growth, and it's non-cyclical organic growth. So in terms of portfolio construction, what we've done is we've looked at all the North American listed agriculture companies, and we look at the largest and most liquid ones, and we construct our universe from that. So on top of that, we deploy what we call a quality screen, which is that we select the 30 most profitable names in the universe of stocks that we selected. And we do that because we think that companies with higher profit margins have better pricing power. And if they have better pricing power, what happens is during high inflation times, they can grow their revenues along with their costs and thus increase their profits. So the inflation hedge kind of is becoming more effective when we deploy that screen. So overall, ZEAT becomes a targeted portfolio of 30 companies. These companies are very heavily involved in the agriculture production side of the food chain. And then we select the 30 most relevant names from there. We market cap weight them, and we impose a threshold of 8% just to ensure the fund doesn't get too concentrated in a handful of names. Moving on, if you look at the top 10 holdings of ZEAT, you'll see names like Nutrien, General Mills, and Deere. If you look at Nutrien, it's the largest producer of fertilizer in the world. Deere is one of the largest agriculture machinery suppliers in the world. So these names are very, as I said, involved in the agriculture production side of things, which is why if you look at the sector allocation, it will make sense that most of the fund is concentrated in sub-industries like fertilizers and agriculture chemicals, packaged foods, agriculture products, and farm machinery. In terms of the overall sectors, that comes down to concentration in materials, in industrials, and consumer staples sectors. So these are more defensive sectors. These are more tied to the agriculture production process. And that is what we were aiming for with this fund, so that it can serve as an inflation hedge as well as for long-term growth. In terms of geographical allocation, you'll see that it's 80% concentrated in the US. However, that's a bit misleading, because if you look at the companies as a whole, what you'll find that they have global operations. So while they're based out of North America, what they're doing is they're deriving most of their, or a lot of their revenues from international markets. So while it's mostly exposed, or the exposure is concentrated in the US, the revenues are global, hence global agriculture. And that's kind of an intro into the ETF, how it's constructed, and what we were aiming for with it.
That's great overview. Thanks, Mirza. And lots of names that we can recognize in that top 10 there. Now, inflation, you've mentioned inflation a lot, and this can be used as a hedge. It's on the minds of everyone these days, but can you touch on why this exposure really could benefit investors in times of higher inflation?
Absolutely. So as I said, one of the key ideas behind coming up with this real assets fund is inflation. So if you look at 2022, we've all probably heard inflation 1,000 times. Some would call it the year of inflation, creating a lot of volatility in the markets. And if you looked at inflation closely, what happened was there were supply chain issues, and then the Russia-Ukraine conflict kind of exacerbated those, leading to higher energy costs, and that fed into higher prices for everything else, including food. Now we have to keep in mind that Russia and Ukraine are two of the largest food producing and food exporting nations in the world, especially for key commodities and key inputs like fertilizers. And other commodities like wheat. So when Russia and Ukraine go into conflict, there's a huge supply chain effect that happens, which reduces the supply of these key commodities, leading to structural supply-driven inflation, which is what we saw. So while if you notice inflation has been coming down over the past few months, one component of inflation that's been really sticky has been food prices. And if we look at the forecast for US CPI, Canada CPI, it's projected to come down, but it won't come down to its target of 2% till 2024 at best. And that's assuming nothing goes wrong. So there are a lot of risks in the current environment. A lot of it is geopolitical. So if Russia-Ukraine, that conflict escalates, we can see a lot more or another bout of food inflation. So as I said before, with ZEAT giving you exposure to agriculture producers, commodity traders, those type of firms, these firms tend to do well in higher inflation environments. I think that's best represented by a company like Nutrien, which is one of the largest holdings in ZEAT. So as I think about 30 to 40% of the fertilizer supply was affected from the Ukraine war, Nutrien had to kind of step in and had to produce more. So in this case, in 2022, if you look at a company like Nutrien, not only did it had to produce more to overcompensate for the lack of supply from elsewhere, it was capturing a bigger market share of the overall fertilizer market. So it managed to grow revenues not just because of inflation coming from higher input prices, but it was capturing a greater share of the overall market. So if you look at what that means is not only are these companies benefiting from higher input prices, they're benefiting from being large producers and capturing bigger market shares. And demand for food is kind of constant, kind of grows up. It's inelastic. So having companies in your portfolio that can become bigger suppliers of an ever-growing market kind of bodes well not for higher inflation times, but over the long term too. This is why we kind of designed ZEAT to benefit from higher food prices, higher inflation, and that's where it can really shine.
Absolutely. Okay, great points there. And then talk to us a bit about how investors can use this in a portfolio. You have some good points around the diversification benefit of it.
Yeah, absolutely. So what we did is we back tested our global agriculture strategy, and we looked at low inflation and high inflation periods to see how it behaves, and that can give us a good indication of how your portfolio would have done had you invested in a strategy like this. So if you look at the top table, or top half of the table, you'll see that the strategy was returning about 12% per year from 2017 to 2021, which we've categorized as low inflation. You contrast that with the S&P, it returned about 16%. So the S&P was kind of outperforming the correlation. If you look at the metric there, it's 97%, so they're very heavily correlated. However, if you look at the higher inflation regime that we have in 2022, the relationship and the correlations break down. And they break down because there are different factors motivating the performance of the broad markets and agriculture. And you have to keep in mind, agriculture companies are not very well represented in the broad markets. And we look at this by correlation drops to about 0.18. The returns for the global ag strategy is positive 8%, contrasted with negative 12% for the S&P. So the strategy outperforms the broad market by about 20%, which is significant, and it goes to show that while inflation was hurting the broad markets, there are strategies like global agriculture that were doing well not in spite, but because of inflation that was driven partly by food prices. And if you look at the chart on the next slide, that kind of illustrates the point. So you see the breakdown in correlation towards 2022, and that's happening right as the Russia-Ukraine conflict is at its peak. And that's when all the energy prices, the fertilizer prices started spiking, which really hurt the broad markets because interest rates had to go up to combat higher inflation. But agriculture equities actually did well and were also less sensitive to interest rate movements. So that's an important point. It goes to show that, okay, agriculture was driven by different factors, and these factors were actually hurtful to the broad markets. So in the context of, say, a 60-40 portfolio, if you have a balanced portfolio of stocks and bonds, adding a satellite position like global agriculture or ZEAT could have shielded you from some of those drawdowns and could have helped you add diversification to your portfolio, just because the risks that were hurting bonds and stocks at the same time, which is rare, were helping ZEAT or an agriculture strategy. So that's where it kind of really shines. It really shone through in 2022. And not only that, we can see that it was returning decent returns, about 12% per year, in a low inflation, low interest rate period. So it kind of is doing well non-cyclically and being less affected by risks that are impacting broad markets.
Yes, I think we all could have used a little bit of that in our portfolios last year. Thank you for that, Mirza. Erin, thanks for your patience and thanks for joining us today. Over the past, I guess, few years, we've seen large movements as shown here in farm product prices, in particular coming out of the pandemic. Can you tell us a bit about that and how these developments have impacted the agriculture sector?
Yeah, happy to be joining, and certainly no shortage of action on agricultural and food prices over the last couple of years. Last year, the U.S. Department of Agriculture's their overall farm price index, which is what we're looking at on the chart here, kind of lumps together all of the different products produced by the sector. It reached an all-time high, as you can see, and these gains were driven in part by this generally strong demand environment coming out of the pandemic, but supply development also a major factor across the board. In the crop space, prices actually started rising pretty significantly back in 2021 because of the severe drought that we ended up with across the North American plains, which actually has continued to today. Obviously, a drought sounds like a bad thing. In many ways, it of course is a bad thing. What you'll find generally, though, is that crop producer revenue actually tends to increase when growing conditions are challenging, because the impact of the weaker production volumes is easily offset by the increase that you see in prices. Layered on top of that, of course, the conflict in Ukraine further reduced global crop supplies, put additional upward pressure on prices. Now, of course, high crop prices, which benefit crop producers, fertilizer companies, chemical companies, they won't necessarily stay as high as they are today. I think worth pointing out, though, here that other segments of the agri-food industry, I'm thinking food processors, livestock producers, these are actually crop buyers. And so when you consider the agri-food space as a whole, a little bit of that crop price risk actually ends up being diversified away. As far as the livestock space, supply developments also generally supply price supportive there, excuse me. And so, for example, the head count of the U.S. cattle herd, it's actually now at its lowest point in more than half a century. Again, largely a story of the drought, but this is something that has been supportive of cattle prices. And then producers have also been very cautious about capacity management in the hog space, also beneficial for pricing. Now, obviously, from kind of a broader macroeconomic point of view, higher farm prices and higher food prices have contributed to inflation. And they've just made central banks' jobs all that much harder. From the standpoint of the agri-food industry, though, obviously the strong pricing environment has been warmly welcomed.
For sure, that's quite the chart. And then on the other side, I want to talk to you a bit about currency, because there's talk that the U.S. dollar has maybe peaked. We may see some depreciation over the next couple of months. But I'm curious, how does currency impact? Because it is a commodity after all. How does currency impact this sector?
Yeah, so like most commodities, the major price benchmarks in the agriculture space are denominated in U.S. dollars. And then, of course, the U.S. dollar, if you look at it in trade-weighted terms, it increased to an all-time high last fall, given the really aggressive rate hikes being rolled out by the Fed. And then, of course, as you would expect, a strong U.S. dollar is generally a negative for U.S. dollar-denominated prices, and it's generally a negative for the competitiveness of trade-oriented U.S. industries like the agriculture sector. Fortunately, though, as you mentioned, it is looking as though the tide has turned. And so as we can see in the chart here, the trade-weighted dollar is down about 8% over the past few months. Again, driven largely by the Fed here, which of course has slowed its pace of tightening over
So the currency at this point has gone from an industry headwind to an industry tailwind. It's now evolving in a way that's supportive of benchmark agricultural prices and should benefit the competitiveness of the US industry. And that's a pretty important thing. This is a trade-intensive industry. US agri-food producers exported around $180 billion in product last year. A more competitive currency should only help to push that number higher. And then the outlook for the US dollar is also fairly encouraging, with the Fed expected to move to the sidelines in the next few months, while other central banks like the ECB continue to raise rates. We anticipate at least a little bit more US dollar weakness ahead. And again, that's something that would be to the benefit of agricultural producers and the agri-food sector.
Okay, thank you. Good to know how those currencies can impact it as well. And then, Marissa, can you talk to us a bit about some of the other tailwinds? You touched on some of them in your first couple slides, but walk us through some of the other tailwinds that you see for this sector.
Yeah, absolutely. I think to start with, climate change is a huge risk. And so if you look at farming practices, not just in the US, but across the globe, what has happened is there's an increased focus on yield. And what do I mean by that? I mean that there is less and less farmland now used in the world, and less farmland is producing more food than ever. And so what's happening is farms are becoming increasingly more productive. However, there's less farmland in the world. So when natural disasters happen, when extreme weather hits as a result of climate change, what happens is there's an increased impact on farmland and farm output, just because there's less land producing more, which makes it more susceptible to damage from extreme weather. And so what that happens is the enhanced focus on yield is very good for agricultural products and agricultural chemical suppliers, as well as for machinery and ag tech in general. On top of that, if there's an impact on the food supply chain, now the food supply chain is more vulnerable, and then we start with food price inflation all over again. So that's one key risk when it comes to climate change. I think we saw that we're still seeing with chicken prices going up because of bird flu. There's increased impact from extreme weather conditions in Latin America that's hurting crop production there. So there are numerous impacts to the food supply chain that can kind of impact how much we're able to produce. Onto deglobalization. So out of geopolitical conflict, another trend we're seeing is more countries want to produce output locally. And what that does is it increases demand for, again, agriculture services, agriculture machinery, and chemicals, which is another tailwind for this sector. If you look at earnings reported from Deere, and a big holding in ZEAT, and also a big agriculture machinery producer, you'll see that demand for agriculture machinery in the United States was at a record, and they're expected to continue growing just because there are just more investments happening in farmland and farm machinery in the US alone. And onto that point of food scarcity, I think, Erin, you put some nice figures there, and that kind of showed that we need more food than ever. We need to invest in food. And investing in food means that we have to invest in these agriculture-related companies that will also benefit because we're investing more in the overall produce, which is good for the ecosystem in whole. Suppliers grow, the producers grow, and then we get more food out of it. Onto population trends, I think I've touched on this before, but agriculture, and especially agriculture equities, tend to be a bit more non-cyclical than other commodities. And that's because food is relatively inelastic. There's just constant demand, and that demand is linked to how much the population is growing. And as countries like India and China grow, not only do they demand more food, they demand a greater variety of food, which also impacts the food supply chain, which now has to create more food and different kinds of foods. And so that's another tailwind for this sector. I've touched on Russia and Ukraine and geopolitical conflict before, how that can impact or benefit certain companies that we have in ZEAT. But overall, there's just numerous tailwinds that can support agriculture and agriculture equities in general.
Yeah, a lot of problems leading to, I guess, opportunities within this space for sure. Erin, we've talked a lot about tailwinds in this sector. Do you have any like headwinds or any things that investors might want to consider or keep their eye on when it comes to this space?
Yeah, I do think it's worth keeping in mind that the agri-food industry is not completely immune to some of the macroeconomic risks facing the rest of the economy. As I say, we're toward the end now of one of the most aggressive and synchronized monetary tightening cycles that we've ever seen. And of course, higher interest rates affect the agricultural space too. For example, by making it more costly to finance pieces of agricultural machinery, which can run easily into the high hundreds of thousands of dollars. We're talking about a capital intensive industry here, and so an industry where financing costs are important. And then in addition to that, most forecasters, including the economics team at BMO, expect at least a mild economic contraction this year. So we are of the view that at least a shallow recession will basically be the cost of restoring price stability after the inflationary genie was let out of the bottle, so to speak, last year. And like most commodities, agricultural prices are at least to some degree pro-cyclical. So they do tend to do a little bit better when the economy is growing quickly, and they can decline during periods of economic weakness. Now, obviously, recession or not, people need to eat here, so demand for agricultural products, it doesn't fluctuate hugely through the business cycle, but what we see is that agricultural supply is very rigid in the short term. Crop production, livestock production, these are natural processes that you can't adjust quickly overnight as market conditions evolve, and so even smaller shifts in demand can sometimes have a meaningful impact on pricing. Again, though, I would point out there is some diversification built into the agri-food industry when you consider it as a whole here. So livestock producers are crop buyers in the form of feed. Lower crop prices tend to boost their margins. And food processors also see cost relief when farm agricultural unprocessed product prices come under pressure. So overall, the agriculture industry is by far not the most cyclical industry out there, but just worth bearing in mind, it does still face some risks related to the current economic environment.
For sure. Okay, thanks for that, Erin. And then I wanted to finish off before the session. We spoke a little bit about the productivity of the sector, and I thought it was interesting. You had some points around that. How is that a positive for the space?
Yeah, I think one of the really impressive things to me about the agriculture sector has been its ability to do more with less over the longer term. Obviously, the most important ingredient to agricultural production is land. Of course, there's a fixed amount of land out there, and actually, the amount of land being used for agricultural production is in decline. And so in the US, for example, total farm acreage has fallen by around 5% over the past few decades. So productivity growth then has been absolutely key in feeding the world's growing population. If you can believe it, looking at the chart here, farmers worldwide are now able to produce around 3 times as much grain out of a given acre of land than they could back in 1960, which to me is just a huge number. And of course, crop yields will fluctuate year to year depending on what's happening with weather conditions, but we really haven't seen this growth trend taper off in any meaningful way. And of course, as you would expect, this productivity performance has been driven by continued innovation within the industry. So for example, this is an example I always like to use, in areas like agricultural equipment, sprayers will now use satellite data to target crop treatments to specific areas within a field that need those treatments. And then plant genetics, another example, they just continue to improve year after year, allowing farmers, again, to do more with less. And it's not just the crop segment either. If you look in the livestock space, the average head of cattle now weighs 30% more at the time of processing than it did 50 years ago, and the average broiler chicken weighs almost 80% more. Again, these are striking numbers. So we're talking about an industry that has a long track record of innovation and also one that's continuing to make a consistent progress year after year.
Wow, what are they feeding those chickens? That's crazy. No, that's incredible, that chart with the productivity increasing, even as you said, with the land being used decreasing, and all of this innovation in the space is really making everything a lot more efficient, it sounds like, especially for the chickens. All right, well, that caps off another great week of ETF Market Insights. Thanks, Mirza and Erin, for joining me today and sharing your expertise. I hope the audience learned something new about global agriculture today. Next week, we will be off. It's Family Day long weekend, but we will be returning on February 24th. I'll be joined by Larry Berman, who many of you will know. He's been on the show before. One of Canada's most famous ETF investors and really a pioneer of using ETFs tactically within an investment management firm. We'll get his thoughts on the markets, whether he thinks there's going to be a recession, whether we're in a recession, inflation, currencies, so much more. He's going to talk about it all. So I hope you'll join us then. Thanks again, guys, for joining me. Have a good day.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.